Welcome to the Broken Pie Chart Podcast, episode number 85, I think. I think it's 85. I'll be your host today. In fact, I'm your host every day, Derek Moore, on the Broken Pie Chart Podcast. So, lately, I've seen a lot of people on CNBC saying valuations are too high. Other people say, well, given where interest rates are, I don't think valuations are too high. And some people say, well, I don't care how low interest rates are, valuations are still pretty high. But what does it mean, or what's the effect of interest rates on stock prices? You know, does it really matter that low interest rates, does it matter that interest rates are so low? The quick answer is, yeah, it does. Yeah. And I'll talk through why that is, but let me just cut to the chase. Yeah, low rates, in fact, more specifically, the low risk-free rate, you know, the rate that you could get, let's say, on a 30-day Treasury bond, or although they're not purely risk-free because you can have a change in interest rates that move around the market value. But you know, you've got bonds that are really low all across the spectrum. So, interest rates matter. They matter a lot. And they matter a lot because a lot of what is, you know, sort of the underpinning of finance deals with how you value assets, how you value cash flows, and also the hurdle rates, the idea that you have to get above a certain amount of return over your cost of capital. So yeah, all this matters. But when we think about why it matters, there's a couple things. Yeah, low rates, in theory, allow for higher valuations, and I'll sort of explain that in a little bit. Your cost of capital, meaning if a company issues stock, what do those shareholders require from a returns perspective? What do they expect? What do bondholders? So a company wants to raise capital, they issue bonds. You know, what is it that they require on an interest rate? When cost of borrowing goes lower, that actually, you know, lowers your borrowing cost, lowers your interest, your net interest payments, but it also lowers your overall cost of capital. And, you know, we think about if your cost of capital is lower, it means it's easier to get a higher return on invested capital. In other words, you know, when companies make money and they take the net income or they take profits, they can either pay it out 100% to shareholders, they can buy back stock, or they can reinvest it back in the business. Like, let's say you own a lemonade stand and you're like, well, I made $1,000 this year. Well, you could pay that $1,000 out to quote unquote shareholders or yourself, or you could take that let's say you take $800 of the $1,000 and you buy another, you know, you set up another lemonade stand somewhere and you hire an employee and things like that. Well, the cost of capital matters because let's say you make that investment. Let's just round it up to $1,000 because, you know, it's easier for us to do math, but you spend $1,000 on that new lemonade stand. And let's say you make, you know, $100, net margin, right? After all your expenses and everything like that. Again, just a crazy example I'm giving you. Well, $100 that's a 10% return on the invested capital, right? Well, if your cost of capital is higher than that, well, then you're not even, you know, let's say, you know, you borrowed that money and the interest rate's 11%. You need to get above 11% before you can say, you know, it's a positive return. So, but anyway, so we'll kind of go through some of those things. But yeah, you know, this isn't to say that things are overvalued, undervalued. I'm just saying that interest rates do matter. They are a foundational thing. They matter in many different places. And one of the things with the Federal Reserve keeping interest rates so low for so long is that you have had different asset classes be able to run a lot higher. And so we'll kind of bring this back to many people have bought a house, or maybe looking at a house or refinanced. You know, that all goes into it. So first of all, why is it? Like, why do interest rates being low or high, how do they affect, let's say, a stock valuation or just the value of an asset? Well, first of all, You have to look at a couple different things. Number one is one of the proxies that we use for interest rates. We say, well, if an investor wants to put money into an asset, maybe it's a stock, maybe it's some other investment, a business, what could they get on a risk-free basis? In other words, with no risk. So one of the things that you do, you say, well, they could probably put their money in a U.S. Treasury bill or a Treasury note. And we know that, unless the U.S. decides to default on interest payments, which of course the U.S. controls the currency, they can always print more. You may devalue the currency, but in theory, right, they're not going to default on the payments, U.S. So right now on a 3-month Treasury, you can get about 12 basis points. What does that mean? You can get, it's way less than 1%. It's 0.12%. On a 6-month, it's 13 basis points, which is 0.13. In fact, 1 year, 2 year, basically 3 year, I'm looking at the Treasury yield curve right now, is 0.14%. The 5 year is 0.26%. 10 year is 0.68%. In fact, you can go 30 years. 30 years is 1.43%. So some of this you've heard there, the TINA, there is no alternative. There you go. But it just kind of goes to show you, if interest rates, imagine, let's say the 3-month Treasury note rate was like 5%. And you might say, well, that seems really high. Well, it wasn't that high in the late 90s, even before, I think, 2007 or so. You had interest rates. You might remember getting like 5% in your bank account. So the reason I bring that up is because on a risk, you're always comparing an investment to what you could get on a risk-free basis, and you get nothing right now. And so if you get nothing right now, then that's going to obviously make the required return on something else much less, right? Because if you can get 5%, you're not going to be happy with a 5% return when you have to take risk in, let's say, a stock. So yeah, the risk-free rate is down, and so that definitely affects things. The other reason why it affects things is people who do this for a living, where they do intrinsic valuation, they do discounted cash flows, just fancy way for saying when you're evaluating a company, whether it's Apple or Microsoft or any number of these entities, and you say, well, I think they're going to earn this much income this year, this much income next year, this much income, where they do it off cash flows. Like this is the cash flow of the business over the next number of years. You're valuing those future cash flows. And the thing is, you have to discount down money that you're going to get in the future by some rate of return that you've foregone. And so the higher the interest rate, the lesser those future cash flows or earnings are worth. I'll give you kind of an example on this. Let's say somebody said, hey, I'm going to give you $1. You'd say, great, I'll take that $1. That's exciting. I'll take that $1, put it in my pocket. But what if somebody said, hey, I'll give you $1 in 10 years? And you say, well, okay, that sounds great, I think. I'll put it on my calendar 10 years from now. You show up at my house, give me $1. But the thing is, that $1 is not that you're going to get in 10 years is not worth $1 today. And you have to, you have to discount that $1 by some rate of return or rate of interest. And so let's say that we use a discount rate of 10%. In other words, if you had the $1 today, and I'm not saying this is what you can get risk-free, obviously, I'm just going to do some quick math for you. But if you had $1 and you could invest it and you think you can get 10%, well, you don't get to compound over each and every year for the next 10 years because you don't have the money. You're not getting it for 10 years. And so what you've got to do is take that $1 that you're going to get in 10 years, and it's actually $1 divided by 1 plus the rate, so that's 1.10, to the exponent of 10. Okay, just a fancy way of saying what's the present value of $1 you're going to get in the future given discount rates are 10%. And the reality is that dollar that you're going to get in 10 years is only worth 30 cents, the present value today. But here's where it gets interesting. Let's say we move the discount rate. Instead of 10%, we move it to 1%. Well, you do the present value where you discount down the value of the dollar that you're going to get in year 10 today by 1%. Now in today's present value, it's worth about 90 cents. So that's a 60-cent difference, right? 30 cents at 10%, 90 cents at 1%. So I bring this up because you can see that if an analyst is looking at a company, by the way, analysts make projections. Even if I could give you 10 years worth of projections on Tesla or Microsoft or Apple, and those can change. But basically, if you have a projection, you say they're going to have these cash flows, these earnings for the next 10 years, you can discount those down. 2 years earnings from now, you discount it down by the discount rate, for 2 years. The ones in year 10, you discount down by a discount rate, 10 years forward. And so you can see that the lower interest rates are, the more that those future cash flows and earnings are worth. And in theory, if somebody's doing an intrinsic valuation, a discounted cash flow valuation, and you're using a lower cost of capital or discount rate, you can see the valuations be higher. And where this gets really crazy is, most analysts, what they do is they'll take, they say, well, I think there's going to be growth for the next 5, 7, 3, 10 years. And after that, I have to assume that the company is going to continue forever. And I've got to have a perpetual growth rate. So maybe they say, well, it's going to grow at 3% a year perpetually, from year 11 through the end of time, right? Infinity. And here's where little changes in that discount rate can make a huge difference in how the value of a company. In other words, if you think interest rates, the risk-free rate or your cost of capital, right? I'll get to that in a second, is going to be much lower for many, many years. That's kind of an interesting assumption, right? So anyway, yes. Low rates do affect. You don't know where rates are going to go in the future, right? And people who model this might change those. How this specifically gets into the cost of capital is there's something everyone's ever taken a finance course. They have something called the WACC or WACC. It's a weighted average cost of capital. And basically, if you're going to start a company, you would do what? Well, you could issue share. You can get investors, right? But let's say you've gone public and you've issued shares. Those shareholders, in theory, based upon the risk of the company, they require or expect a certain amount of return. And then bondholders, when they issued bonds and they buy bonds, right, based upon the risk of the company and current interest rates, those bonds require a certain rate of return, or rate of interest, I should say. And so the quick back of the napkin on this is, let's say, and by the way, the cost of equity, it's out of the scope of this podcast, but basically it's, if you use the textbook definition, it's they call it the capital asset pricing model. You take the risk-free rate plus the beta times the equity risk premium. I won't get into all that. But let's say, the cost of capital for stocks is 10%, and the cost of capital for bonds for this company is 3%. And the company, it's like 50-50, right? Easy math. So 50% of the capitalization of the company is made up of stock that's out there, equity, and the other 50% in bonds that are issued. And so if you have a 10 and a 3%, the cost of capital is about 7.5%, okay? But beyond the scope of what we're going to do. So the point is that that cost of capital is going to go up if interest rates are much higher. And the other thing, too, that's sort of interesting about this, if you could buy a bond right now and get 10%, and it doesn't even have to be completely risk-free, right? Let's say you could buy a 10-year bond, U.S. Treasury, and get 10%. Of course, you have market value risk because if interest rates go up, the value of those bonds go down and vice versa. So that's why we say that really the only true risk-free is on the very short end of the maturity curve because there's less interest rate risk. But yeah, if you could buy a 10-year bond right now for 10%, you might be like, wait a second, I can go into bonds and get 10%. And I know I have interest rate risk, but not the same risk as buying, let's say, some stocks. You might opt to just do the bond. And so the reason I bring that up is because with interest rates, bonds basically paying next to nothing, and you do have interest rate risk, especially further out on the curve, it's just one of those things that a lot of investors, there's talk about this, the whole there is no other alternative. A lot of investors are okay not being in bonds and being in stocks. And so anyways, so I thought this is a question I get a lot, and I know I see it on CNBC. I see it on Bloomberg, and people are coming on. They're like, given where rates are, I don't think valuations are too high. Or given where even as low as rates are, valuations are still too high, right? So it doesn't mean the valuations are high or low. It's just that the lower rates are, the lower the required rate of return is. And also it's the idea of where can people go to get a return? And when rates are this low, certainly on the U.S. Treasury curve, it's, your cost of equity goes down. And then bringing it back, remember I talked about the lemonade stand, and I probably botched that example, but it's just one of the measures, like if you were looking at fundamentals of how a company is doing when they reinvest profits, one of the ROIC, they call it, the return on invested capital, it's this whole idea of like, okay, we have profits, we can pay them out to shareholders, we can buy back stock, we can reinvest them in the business. And the idea is that when you reinvest money in the business, you hope that you get a return that's higher than your cost of capital, right? Sort of makes sense. And so the lower that cost of capital is, the less return they have to get, less return on invested capital to actually get over that hurdle of their, the required return on the investment. So it gets a little beyond, quick examples. So a couple things to watch here. You can, and I'll put a link to this to the U.S. Treasury curve. Most people probably see on CNBC the different yields, but you can take a look at the curve, and you can also go back. For example, if I go back to 1999, and let's see if it'll let me do this on this side. If it does, oh, there we go. Yeah, so January of 99. Let's see where we are here. Yeah, January of 99. I look, and the 3-month Treasury was yielding 4.49%. Actually, the yield curve was pretty flat. Flat meaning, 4.49. The 10-year was 4.69. So in other words, the front month was very close to the back month. So you have a flat yield curve. But then we go. I mentioned, 2007-ish. Let's look at 2007 and see what interest rates would have been back then. Yeah. January 2007, you had an inverted yield curve where the 3-month was 5.07% yield. The 10-year is 4.68. So that was kind of an interesting time. I'm going to go back to 96. 96 should be no, I can't. No, I can go back to 96. So I'll put a link to this in the show notes so you can check that out. But yeah, you go back to 96, and you probably remember back then your bank account, if you had a checking account, you're probably getting 4%, 5%. But yeah, the 3-month was about 5%. 30-year was, just under 7%. So yeah, interest rates matter. And that's why I'll also link to an episode I did on the Buffett indicator, because Warren Buffett, or people have taken comments he made. I think it was a Fortune article, but I'll link to the episode. I talk all about it. But they always look at, the they call the market cap to GDP, the Buffett indicator. And those are never really adjusted for the cost of capital or what current interest rates are. So those who look at that and say, well, the market is highly valued compared to previous years in the Buffett indicator, they never really look at interest rates. So I'll link to that episode as well, but keep that in mind. As always, please share this with someone that you think might enjoy it, especially somebody who hasn't listened to a podcast before, and keep those comments and questions coming. This was another listener idea. They asked me to take a look and answer the question because they always watch financial news networks and they hear people talking about it, but hopefully this kind of clears it up for you. All right, folks, we'll talk to you all next week.